And that's if you traded the maximum swing. So we know that the maximum swing normally is what we would count for 3 contracts. So if you were trading 3 lots, then your profit from yesterday, based on the tweets, would have been approximately $12,000 on the Nasdaq. So that's pretty good. In anybody's world, that is pretty damn good. And when you look at the tweets, again, it's about making sure that you understand what you're seeing, making sure that you understand what you're doing, making sure you understand what the tweet is. And it wasn't particularly difficult. It was relatively straightforward. There was a good, strong tweet, and there was a market structure tweet. And if you understood both of them, life became very, very simple for you. You'll see from the tweets, we had a tweet here at 12:30 lunchtime on the 8th of January. And at 12:30 lunchtime on the 8th of January, you can see that we've given you a particular price that we know is going to be the bottom price. Dealers need to keep the price bid at 59.16s, or they will get placed under a lot. There was a lot of pressure below 59.16. The chances that the dealers were going to see that 59.16 going offered were almost zero. That's why we obviously were encouraged to send the tweet out at 12:30. Well, remember, 12:30 is over here, right? So that's when the tweet comes out over here. Well, you can see what's happened in the afternoon session. Look at the price, guys. S&P 59.16. The bottom tick price where the market went up. You couldn't make it up. I mean, it's on the tweets. It's there. It's visible. You can actually recognize that that was the bottom print price that we were looking for. And, when you look at that one swing, even that one swing, it was worth an absolute fortune if you'd acted on the tweet itself, if you'd acted on the play itself. So there is another piece to this jigsaw puzzle, of course, and that is that we're obviously aware of what's happening on the SPX, and and it doesn't matter whether I look at this on the SPX, the S&P, or indeed even the Nasdaq. You'll see what we sent out at 3:50 at 3:50 US time, London time yesterday, which is in the afternoon, early morning for the US. There's a lot of direction being built, bringing new volatility extensions. So what does that mean, volatility extensions? It means that if you're going to try and buy it on a fade, you're buying it at lower lows. If you're going to try and sell it on a fade, you're going to be selling it at higher highs. So we're not trading until we test those lows and highs, right? So we're not going to be looking to get long unless we're into those low prices, or short unless we get into those high prices. And where the tweet comes out at 3:50 is where this red line is. So what I was asking the guys in the room this morning is, well, what are you going to do with that tweet? What do you read into those tweets? Well, what I would read into those tweets is that we should be buying to press the top edge and selling to press the bottom edge because it's going to extend. That's one possible trade. If you're going to try and fade these areas, we want to fade them at lower lows and higher highs. And that means that what you're going to have to do is simply draw a prior swing high. There's the prior swing high there. You're going to draw the prior swing low because we know that if we're going to buy it, we're going to buy it below it. We know if we're going to sell it, we're going to sell it above it. There's nothing difficult about any of that, is there? Very, very easy, in fact, to recognize the stories. So what happened? The price went above it and sold. What happened? The price went below it and bought. And where did it buy from here? It bought from 59.16, a price that we had already told you was where basically the dealer's last stand was going to be in terms of defending a bottom edge. 59.16 was going to be that price. And that price happened to be a market extension which was available to you on the prior tweet right there. The takeaway from that trade is absolutely sensational. So when we then tap the top edges, yet again, we can see that we take out the top edge and we make another sell-off coming in. So you can see that this tweet here, we had a beautiful sell here, a beautiful buy here, and a potentially beautiful sell here. Thousands of dollars of profits just by trading the tweets. Thousands of dollars of opportunities by looking for and recognizing the trade that's setting up in those areas. Unbelievable. But it's only unbelievable if you execute, isn't it? It's not unbelievable if you just acknowledge that it was a good tweet. Well, we don't want it to just be a good tweet. When we like a tweet, it means that we understand the tweet. When we like a tweet, it means that we are trading the tweet. When we like a tweet, it means that we're in and about it, and it's helped you to make a lot of money. And that's what we like about likes, because it sees that there's people making the big bucks and the big trades and the big swings. Because if you're not taking that information, this is the best information in the world here. Honestly, I mean, where else did you see 59.16 print? Did anybody see 59.16 on the S&P print anywhere else? Did anybody else get any tweets about 59.16 on the S&P being a buy trade? No. You could look high and wide. You could look across the whole entire complex of tweets and messages and all of these kind of things across every single platform, and there's very few, if anybody else, telling you that the dealers need to buy 59.16. We did. We told you that the dealers need to buy this 59.16 or they're in trouble. The dealers then bought 59.16 a few hours later to stay out of trouble. And we got this amazing buy-side profit. So if you took advantage, well done. We're well into the $30,000 a contract over the last few days of simply just these tweets. And if you're anywhere near that, then of course you are absolutely ecstatic about what you're seeing developing here in terms of these live levels that are developing in real time. So we can't get any better than that. We bottom ticked it, we top ticked it, we bottom ticked it, and we top ticked it. We cannot get any better than that. It's physically impossible. Nobody can get any better than that. So it puts it into perspective as to just how good these ideas are, these swings, these market maker levels where we know there's going to be an opportunity to play. A few other things that we've seen this morning. I've been selling some oil, and I was talking about the crack spread skews, but we don't seem to have any interest in them anymore, so we're going to just drop them off the curriculum. But I like them. I mean, I've always liked the crack spread skew, but there seems to be pretty much a zero interest in them. And for that reason, there's not a lot of point in spending time over it because we've got other things that we need to be focused on. The trade that's pissing me off today, and I'm really, really annoyed because I talked about it to the guys in the room this morning, is the buy on oil. I can't believe I never got it. I cannot believe I never got the buy trade on oil. I was waiting for, literally, and this is the honest truth, I was waiting for one more tick. That was all I was waiting for, was one more tick. And I never got it. And because of that, I missed the opportunity. I was waiting for that liquidity because the liquidity was so skinny, guys. It is obviously a US holiday. Holiday, it's not really the right word you can use for this type of day, is it? So, US day off, US day of mourning, basically. So this was the trade. I mean, based on the model, you can see based on the model, it's the basic idea, of course, from this model, which we talked about a few days ago, is I'm trying to be short if I can get above the red line, and I'm trying to be long if I can get below the red line. So when we're looking at the model here, you can see that we had a very, very big pool of buying opportunities down here, didn't we? We had a beautiful opportunity to get long into the bottom swings here. Nice opportunity to get short here in the London Open. And I was obviously looking for a buy trade in here, and I was looking for a sell trade here. How good is that little cheeky model, guys? How good is that little model? Well, let's take a look and see how good that model is. Let's see if it actually generates any money. So there's the buy trade coming in here. So I'm now looking for the buy trade. I'm looking for the volume arrival. There it is. I buy the volume arrival there. We got a very nice lift off the price. Now, you might be saying, why did you take the trade early here? Well, I took the trade early because we were literally one tick away from the red line, and we got a big volume arrival by taking out the prior swing high. So I sold into that. I sold into that breakout to the top edge, and we got a reasonable response on the bonds here. Now, here's of all the trades to miss, here's the trade that I missed. And you can see why I missed it, because I've already told you about getting the buy trade here because of the volume and getting the sell trade here because of the volume. So obviously when I'm looking at this buy trade here, I'm now looking at the volume and I'm saying there is no volume. There's none. So I was waiting literally for a single tick more to take out all the stops off this 7 print. This is the ZB contract, not the Ultra Bond. Likewise, in the Ultra Bond, I was waiting for a break of 16 to take out so that I could buy at 15s or 14s with a bit of volumes. Never happened. The price did not generate any volume for me to buy into, so I sat waiting. Now, obviously, what happened in hindsight is dead obvious. In hindsight, we got all the volume piling in here at 10s and 11s and 9s and 8s, right? So the volume all piled in here. And obviously the decision in hindsight that I should have made, that perhaps some of you made, was to get long into that volume there. Again, using my own suggestion, you shouldn't be waiting for liquidity at the bottom edge if the volume shows up at another price, right? So I've missed out on my own education here. Maybe I need to reset the classroom. So I didn't cross the spreads. Actually, to be honest, I was busy on another market at the time, but that's my excuse and I'm sticking to it. So, yeah, when you see the volume, guys, you then have to look at it and say, well, look how close we are to the red line here. We're so close to the red line there that we really, it's only something that you've put on a chart, right? It's not real. It's just a red line that you put on the chart. So there is no hard and fast rule that it's got to be through the red line. But if you're going to try and build a systematic trade response, then of course it has to have a rule. And if the rule is it's got to be through the red line, then it's got to be through the red line. So anyway, we miss out on the opportunity, and that would have been the perfect buy trade here at 8s, trades all the way up to 22s. Pissed right off about that trade, so really disappointed that I never got that bit of business done. But again, is what it is what it is. So got to the top edge. You can see we went above the red line here. The volume is very good. Absolutely superb volume. And all I'm going to now do is sell the 22s. Sell the 22s, 21s, and we're already trading 16s. In the ultra bond market, the same trade was selling the 3s, and we've just traded 27s. So you can see this model is very, very, very accurate. Very accurate indeed. It's a very high percentage probability model, isn't it? And what else it does, of course, is it helps you to stay in trades, because what I said to the guys early was that, when you're looking at what's going on at these higher prices up here, and this is when I was talking about this buy trade here, you'll see that even at higher prices, the model stays below the 50 line for the majority of the time. You see that? So because the model stays below the 50, it means that basically everywhere is a possible buy. Everywhere is a possible buy, even at higher prices. Well, that means if it's even a buy at higher prices, then it's going to go up. You can see that the model changes here, where most of the trade flips are now on the sell side, and obviously you're now looking at that saying, right, okay, we're no longer going to buy at top edges anymore, right? That's the simple read here. We're not buying at top edges. What we're trying to now do is find the sell reversal trade, and obviously the volume arriving at exactly the right time gets me short off the 22s and makes some nice money. It's a very, very good model, very accurate, and has a real good history in the US session from yesterday. Take a look at the model trades that we got yesterday, and you'll see just how good these model trades are. Do you see the buy trade there? Red line, black line below the red. Good arrival of volumes. Boom, there she goes. There's one trade winner. Beautiful. What a start to the day, right? What a start to the day. Does everybody see the next buy trade here? Do you see it? You see the next buy trade? I keep getting that stupid thing, don't I? So there's the next buy trade there. Do you see the model showing me that beautiful bit of business there? Look at the arrival of volume, buy trade, boom, there's the money shot. There's the money shot. I did take a short sell here. We got above the red line here, so I did take a short sell into that. You might be saying, where's the volume? But we had taken out a previous level, so if we're not going to get volume there, we're not going to get volume full stop. So we just had to take a shot at it. Got a reasonable sell response. And does everybody see this? The last sell trade. The last sell trade I took, good arrival of volumes coming in here. Do you see it? So there's the last sell trade there. There's my opportunity to deal. There it is there. There's the model. Yeah, everybody sees that? There's the sell trade there. There's my opportunity to sell into this top edge. Remember, there's the top edge there. So we're getting that nice liquidity. We're getting that nice volume. And what a beautiful sell-off. What a great model. 100% winners, guys. 100% winners. You couldn't make it up. Couldn't make it up. So, good trades, nice outcomes. Again, is what it is. We've also had as I said, the crack spread trades. I was a little bit of short there, but we've lost a bit of value again. So I'm going to have to just wait to see if we get any more. We went 75 short down to a low price of 57, so I'm happy with 20 ticks. Remember, a scalp trade. Generally, when you're trading any of these types of skews, you're selling in an uptrend and you're buying in a downtrend. You're trying to get the scalp, and sometimes those scalps turn to swings, and that's why I love things like the crack spread skews, because on the odd occasion, one in every three, one in every four trades turns into a swing trade. And if I can get that type of trade going in terms of a swing and one in three, one in four, and every other trade is a nice profit with a scalp, it's a business plan in a box, guys. It really is a business plan in a box. Anyway, in terms of data-wise, we've had a few rumbles about the UK economy again this morning. Lots of chatter about Bank of England saying that the Chancellor's gone off the rails, basically. No surprise there. We've been saying that since the Labour Party came into power in the UK. They've been an absolute shit show. It's been horrid, horrid, horrid. Anyway. Looking at the data we have seen so far, we've had the Chinese PPI and CPI numbers coming in relatively subdued. PPI numbers at minus 2.3%, and the CPI numbers month on month at 0%. They were forecast to be 0.3%, so quite a subdued Chinese inflation number. Eurozone retail sales disappointed badly at 0.1%, down from a forecast of 0.4%. Prior, however, was revised up to minus 0.3%. But obviously these numbers, if they keep repeating and repeating, start to lead to this idea of recession coming into the UK, coming into the Eurozone going forward. And that's obviously going to be something that we may be talking about this year, is how much of this is going to create recessionary pressures. If interest rates stay higher for longer, recessionary pressures. The latest reports from the Bank of England suggesting that there's a lot of wage cuts coming up in the UK. There's a lot of unemployment coming up in the UK. There's a lot of people thinking of laying off people this year in the UK. So there's a lot of pressure on business as soon as Labour Party started to rip up the normal sheet of information and saying, well, we're bringing our own thing in, which means we're going to tax everybody until you all go out of business. That's what their idea is. It's a very, very nice socialist idea that if we tax everybody, we can give the money away to everybody else. Wonderful, great idea until everybody goes bust, of course. Anyway, that's the plan. That's their game plan, and it seems to be working. They've taxed everybody, and they're giving it away to everybody else, and they are causing the market to get a little bit of a collapse taking place in the last few days. It's not looking healthy. Anyway, into the afternoon session, and we don't have anything of any interest whatsoever, so I don't think there's going to be much else for us today. We may well do a wee quick classroom to finish off the day, just simply because people might still be around at 4 o'clock. But we'll maybe do a quick half-hour classroom, guys, at 4 o'clock if anybody still wants to stick around for it. But I don't think there's going to be anything this afternoon. It's going to be very, very muted. So if you're done and dusted for the day, you're done and dusted for the day.